Welcome to Looking at the Markets with David Modell. Well, we had a correction in the S&P 500 in February, and the stock market has been going either sideways or upwards ever since. We're hovering near all-time highs. Is this justifiable? Is it sustainable? Let's take a look at the economy, see how we're doing. Well, right now in the United States, we have a debt to GDP ratio of over 100%. This is tradingeconomics.com. I want to give them credit. And about 10 years ago, the debt to GDP ratio was more reasonable. And now, and this has been going on for a little while, and it's just getting worse over time. The United States, we now owe more than we produce. That's not good. And it does not justify a stock market hovering near all-time highs. How about the future? This is the present and the past. How about the future? Well, according to cato.org, and according to this chart, the U.S. is now the only advanced country projected to see a rising debt to GDP ratio in the coming 5 years. So we saw that it's been over 100% for a while now, and according to these projections, look at all the other countries in the world and look at the United States. It's just going to get worse all the way through 2023, according to cato.org and their research. What else am I seeing in the economy? Well, the U.S. inflation rate over time is just getting higher and higher. In fact, it has jumped quite a bit in the past quarters, according to tradingeconomics.com and their research, and that's not good for the consumer because consumers cannot afford to make as many purchases, and the consumer cannot contribute to the economy, which is not good for the economy. And also, rising inflation also causes the Federal Reserve, generally speaking, causes the Fed to raise interest rates in order to keep up with inflation. They have to keep bond yields, treasury yields, up with inflation. Otherwise, people are not going to buy treasuries from the United States government. And so when we have a sustained increase or jump in the inflation rate, that tends to cause the Fed to raise treasury yields, bond yields. And the U.S. stock market does not like that. It gets nervous, it gets scared if and when the Fed raises interest rates, which I project it will do. It must do it in order to keep up with inflation. And so I see that happening in the near future. And here's another thing we should look at. This is FinViz. It is a stock screener that I like. And usually when I go to the descriptive tab and I enter in mega caps, you know, those large companies, those large, extra large cap companies, the big ones, the famous ones, the Apples and Amazons of the world. The Dow stocks are generally in the mega cap category. And then I go to technicals and I'm looking for, let's say I'm looking for mega caps that are 50% or more below their 52-week high. So in the bottom half compared to their 52-week high. Results, none. No mega caps fit that description. All right, I'll be a little more lenient, a little more relaxed. Let's go for 40% below their 1 year 52-week high. Nothing. All right, let's be a little more lenient. How about 30% or more? I'm getting a little desperate here. Nope. There are no bargains in the stock market, as we can see, at least among the really famous companies. How about 20% or more below the 52-week high? We got Facebook here. I've had to go all the way up to 20% or more below the all-time high. So there's one company 20% or more below its all-time high among mega caps. How about 10% or more? Let's see. Can we at least get a few? 14. All right. Then we got Alibaba, Chevron, Facebook again, Intel, a few more. Only 14 mega cap companies are 10% or more below their 52-week high. That means that the big companies are all trading near, almost all trading near their all-time high. I should be able to get some in the 30s, 40s, and 50s below their all-time high. There should be some bargains out there. There are none. They're all trading near their 52-week highs, or at least the vast majority of them are. I shouldn't have to work this hard to find a bargain in the markets. If you're thinking about going long the S&P 500, the Dow, the NASDAQ, the Russell, anything like that, I would say, in my opinion, you have to make your own decisions. I'd say this is not a time to do it, not a time to get started. If you've been in for a long time and you want to stay there, actually I don't even recommend that. It's a great time to start, in my opinion, start taking a little bit off the table, scaling out a little bit, consider some alternative investments. And if you'd like more information about that, you can email me at any time. I can help you with your portfolio. My name is David Modell. My email address is davidmodell@gmail.com. Do I see trouble ahead? Well, I'm just going to let the facts speak for themselves because I'm only presenting the facts here. I inform, and it's up to you to make your decisions. Well, I'll tell you what, if you like this video, please give it a thumbs up on YouTube and leave comments. Tell me, what do you think? Do you think the economy in the United States justifies these near all-time highs in the stock market? Should I have to work this hard to find bargains? Is that normal? What do you think? Tell me in the comments below this video. And please subscribe to my YouTube channel if you didn't do that already. Hit that bell on YouTube so you can receive the latest updates on my financial educational videos. Thank you so much. I appreciate it. I'll talk to you again soon.